In 2008, the world was standing on the edge of something unprecedented, a financial system so large and so deeply interconnected that its collapse could have brought down the entire global economy. And it all started with something very ordinary: housing loans. To understand how this happened, we need to go back to the early 2000s. At that time, the United States economy was expanding, and banks were aggressively looking for ways to increase lending. Mortgage loans became extremely easy to obtain. In many cases, banks were approving loans without properly checking whether borrowers could actually afford to repay them. At first, this looked like a breakthrough. More people were becoming homeowners, and the housing market was booming. As demand increased, house prices started rising rapidly. This rise in prices created a powerful illusion that housing was a guaranteed way to make money. People began to believe that prices would continue increasing forever. This belief encouraged even more borrowing, more lending, and more risk-taking. Slowly, a housing bubble began to form, but banks didn't stop at just giving loans. They began combining thousands of mortgages into complex financial products and selling them to investors around the world. These products were rated as safe, even though many of the underlying loans were extremely risky. For a while, everything looked stable. Money was flowing. Housing prices were rising, and the financial system appeared stronger than ever. But underneath this surface, risk was quietly building up at every level of the system. The real problem was that almost no one fully understood how interconnected everything had become. A failure in one small part of the system could now spread across global markets. Then the turning point came. As interest rates changed and economic pressure increased, many homeowners began to struggle with their mortgage payments. At first, it was only a small number of defaults, but gradually those numbers began to rise at an accelerating pace. The housing bubble had started to collapse. As home prices fell, a dangerous reality emerged. Many homeowners now owed more on their loans than their houses were actually worth. This meant they had no financial incentive to keep paying, so defaults increased even faster. The financial products that had been built on these mortgages began to lose value. Banks and investors started realizing that the assets they held were far riskier than they had believed. Confidence in the system began to break. The most critical moment came in September 2008, when Lehman Brothers, one of the largest investment banks in the world, collapsed. This was not just a company failure. It was a signal that the entire financial system was under extreme stress. Panic spread instantly across global markets. Banks stopped trusting each other. Credit markets froze almost overnight. Lending came to a halt. Businesses could no longer borrow money to operate, and many were forced to cut jobs or shut down completely. What started as a housing problem had now become a global financial crisis. The crisis did not remain limited to the United States. Because these financial products had been sold globally, banks and institutions in Europe, Asia, and other regions were also heavily exposed. When confidence collapsed in the U.S., it triggered a chain reaction across the world. International markets fell simultaneously. Economies slowed down at the same time. It became one of the first truly global financial crises in modern history. Governments and central banks were forced to intervene on an unprecedented scale. Trillions of dollars were injected into the financial system in an attempt to prevent total collapse. Emergency policies were introduced to stabilize banks and restore confidence. But recovery was not immediate. The damage had already spread through every level of the economy. Families lost homes. Businesses shut down. Millions of people lost their jobs. Entire countries entered long periods of recession. What made the crisis even more dangerous was that many of the warning signs had existed for years. Rising debt levels, aggressive lending practices, and overconfidence in financial models had all pointed toward instability. But because the system was growing so quickly, these warnings were ignored. No one wanted to slow down a system that was generating so much profit. And even years later, the effects of the 2008 crisis continue to shape global financial systems and economic policies. Because the truth is simple, modern economies are built on trust, and when that trust breaks, even the most powerful systems in the world can begin to collapse.